Unprecedented times call for unprecedented measures, and with the CV virus putting a stop to the entire global economy, the Federal Reserve has countered by creating trillions of dollars of stimulus at rates and levels that we've never seen before. But it's about to get even crazier. In this video, I'm going to explain that the Federal Reserve has plans to start a new program, an experimental monetary program that could have strong repercussions, especially if you're not paying attention. So stay tuned. All right, welcome back. If you are new to the channel, my name is Mark Moss. I like to talk about making money. We talk about investing money. We talk about just having overall success. These are the most important topics, especially for today. How can we survive in this new paradigm, this new world that we have? So if you like any of those topics, you want to know more about making money, investing, and having success, click the like button. Helps more people see the videos. Also hit the subscribe button, the bell notification, so you're notified every time I put the videos out there. Go ahead and do it now. I'll wait. All right. Now, back to what we're talking about, the central banks. We're talking about their stimulus. We're talking about this experimental policy they're about to take on that could have massive repercussions. We don't know, but we're going to talk about it. So the central bank, they've been hard at work. What have they been doing? Well, they've been trying to keep the quote-unquote market under control, as if a market could be controlled. But they're trying. They're trying the best that they can. And since their creation, they've been trying to manage this, but it just seems like they continue to make the problem worse. And so basically they've created all this debt, they've inflated the money supply, and the market just keeps trying to correct. It keeps trying to deleverage back down, and they try to pump it back up, and it deleverages back down, and they pump it back up. Imagine like a giant balloon. They pump and pump and pump and pump with debt, with money creation, but it's fake. It doesn't work, and so it tries to deleverage down, and they try to get it back up, and on and on and on. It's just this cycle. But the balloon, the inflation gets bigger and bigger and bigger. It's kind of like a big balloon. Imagine if you had this big balloon that you kept pumping up, but it kept getting holes in it, and so it got a hole in it, lost a bunch of air, and I patched it up, and then I pumped it back up, but I pumped it up even bigger, and it's just like that over and over and over. And so that's what the Fed does. That's what the central banks do. The tools that they have to fight this, the tools in their bags, are basically money expansion through debt creation and interest rates. So those are the two things. And of course, when interest rates go down, more people borrow. That's how they create the money, through debt expansion. So that's how those two things work together. Interest rates down, borrowing, debt going up. And what the Fed does is they try to control this typically with short-term rates. And right now we have short-term rates are almost at zero, pretty much at zero for the most part. So then what could the Fed do, right? I mean, if interest rates are zero, what's next? Well, we've talked about negative interest rates, but that's not what we're talking about today. We're talking about some time for some untested, unproven monetary policies that I think we're going to see probably by the end of the summer. And it's so experimental, it's only being done in two different countries right now, and that's Japan and that's Australia. Now, Japan, we've talked a lot about Japan because it's kind of 20, 25 years ahead of where we're at. And so everything they're doing is starting to trickle its way into the U.S. And so, they've been experimenting with this for a while. And I think we're next, like I said, along with Australia, and probably by the end of the summer. Now, why do I think that? Well, at the last Fed meeting, the FOMC, the Fed started talking about, what else they can do to fight this, all the stimulus, trillions of dollars, et cetera. And of course, they start talking about the Fed setting the interest rates. Now, at the meeting, they started talking about the policy, the possibility of putting this new policy into use. As a matter of fact, the New York Fed President John Williams, the Fed Governor Lael Brainerd, they're both supporting this new policy. And basically, like I said, with short-term interest rates at zero and trillions of dollars of stimulus already put into play, I mean, what else can the Fed do, right? Interest rates at zero, money's there. So it has to focus on the longer interest rates. Now, before I dive into that, let me just talk about interest rates real quick, okay? So as you probably know, because you've probably had to borrow money or you've loaned money at least, but when you loan out money, you typically want that money back, of course, and you want it back with interest. I should be paid for the risk I took for loaning out that money. The opposite is true. If I borrow money, I expect to pay the money back with interest. And that way the person who loaned me the money could be compensated. So in a free market, interest rates are based on supply and demand, of course, like anything else. And at the end of the day, everyone can get as complicated as they want. It always comes down to supply and demand. And so money, interest rates also are on supply and demand. As you might imagine, the more risk that the loan takes on and the less available money, the rates will be higher rates, right? And less risk and more available money equals lower rates. I mean, that's just obvious, right? So if I have to take on more risk, I want to be compensated for that risk. If I don't have very much money, then I'm going to raise my rates. If I have tons of money and it's very, very low risk, then it'd be low rates. Makes sense, right? But the problem is the Fed wanting to create debt and wanting to take on loans and then having to deal with interest rates. And so what happens is when the investors don't want to loan the money to the Fed, right? Or let's say the investors, they don't want to loan it because they want higher interest rates. The Fed's not going to pay them a high interest rate. They want a high interest rate, so they're not going to do it. So what does the Fed do? Well, they just loan money to themselves. And then when they loan money to themselves, guess what? They could charge whatever interest rate they want, all right? But in our world with the Federal Reserve, the central banks set the short-term rates. And then usually the longer-term rates, they let the market still kind of decide a little bit what should be on those longer rates. But in times like these, like I talked about, extraordinary times requiring extraordinary measures, and these extraordinary times that requiring the Fed to produce trillions and trillions of dollars just to try to keep the economy somewhat in check, well, the Federal Reserve now has to step in even bigger. And so the policy that I'm talking about is something called yield curve control. Yield curve control. Now, you probably started hearing about the yield curve back last year, and they started talking about these two different yields, and when they invert, how that was a sign of a recession, a depression coming, something like that. So you started probably hearing about this last year, but this is actually trying to control it, take control of it. That's why it's called yield curve control. And so basically it's a relationship of bonds with varying durations. So bonds are debt. So the government wants to take on debt. They issue a bond. And then we issue those bonds have varying durations, meaning I can buy a 1 year, 5 year, 10 year, 30-year bond. And as you would probably imagine, that investors that typically put their money out for longer want a higher interest rate. So, okay, if you give me my money back in a year, I'll do it at 2%. But if I get it back in 30 years, I want 4% or whatever it is, right? And so longer yields typically give a higher return. And so what this does is it puts the curve upward sloping, because the short-term curve would be low, the long-term curve would be high. And so it gives us this upward sloping. And what the Fed's most likely to do is basically follow exactly what like Australia is doing. And basically they've been putting the treasury debt out there, and they've been choosing debt with maturities between 2 to 5 years as their target. Now, the only other time that the Fed has tried something like this before was back in World War II. If we're going to go back into history a little bit, you know that I love to do that. And so World War II is really the last time we saw this. And basically the Fed at that time put a cap on what the yield, so there's a maximum that the interest rate would be able to do, and it was a cap on 30-year bonds and T-bills, treasury bills. So now if we see this get put into place, if we see the Fed pull this tool out and start to use it, I mean, it could really help the debt markets, obviously. They can continue to produce more debt knowing that the interest rates will stay down. The fear is, as you might imagine, you take on all this debt and then rates go up and then you can't afford it. Imagine if you went and bought a big house, maybe overextended on a house, and you bought it on an adjustable rate mortgage. Well, the fear is that if that rate goes up, you may not be able to afford it, and that's exactly what we're dealing with. So if they can guarantee that the rates won't go up, well, then of course it helps the debt market, right? And if they can expand the gap between the 5 and the 30-year treasury yields, and they do that by suppressing what the real rates are. So if they suppress their rates, and if they can continue to lift inflation, which of course that's always the primary goal of the Fed, if they can get more inflation, it makes paying off the debt even easier. So the Fed is always trying to get more inflation, and that's the whole point. They're always trying to target like a 2% inflation, meaning that prices are going up by 2%, at least per what they measure anyway. And they just can't get it. They can't get the 2%. And that's because we're seeing so much deflation. And so, again, it's like a balloon, right? Debt is imploding, it's deflating, or it's inflating back up. And it's this constant seesaw. So the Fed is fighting deflation, trying to get inflation with 2%, but can they get it? So far, they haven't been able to, and that's the big battle. And you see all these economists battling this out, inflation, deflation, hyperinflation, which is it going to be? But that's the plan. They're trying to get the inflation. They're going to fix that yield curve. Now, this type of policy isn't without its risk, as I stated out in the beginning, right? Of course, there's risks. When you try to manipulate anything, it's always going to have some sort of a lasting consequence. Now, getting the market stuck, or I should say getting the market addicted to 0% rates, meaning the market won't even work unless I peg it at zero, which of course, that's what we're dealing with, right? That's the whole point. They want to capture this. So when you get the market stuck or addicted to 0% rates, how can it get off of that? It's kind of like if you had a patient and they were hooked on morphine, right? And super addictive. And then how can you get them off of there? Once they're addicted, it's really difficult. And so same as with the economy. It's not only difficult, it's almost impossible to reverse this. The Fed never really raises rates after they've been able to lower them. And why would they? If they've issued all this debt that requires a low rate, how can they raise it? And so that's the problem. How do we ever get back to normal? They talk about, hey, we're doing this only to get us through this time, and then things will get back to normal. But history shows they never do. And how can they when they're addicted to 0% rates? And so basically what that means is more debt. That means more money creation. They're going to keep pushing for inflation. And so, like I said, the battle is just going to keep raging on. Is it going to be inflation? Is it going to be deflation? Is it going to be something else? Let me know what you think. Leave me a comment down below and let me know, is the Fed going to win the war on inflation, or is deflation going to win? Or are we going to see something totally different? Either way, let me know in the comments down below so we can have that discussion. I try to reply to every single one. Leave me a thumbs up on the video if you like it. If you don't like the video, that's okay. Give me a thumbs down, but just let me know either way in the comments. That's all I got for you today. To your success, I'm out.